Hello and welcome back to Almus Market Mornings, your daily dose of financial updates with Shikhar Garg, your host. Now, folks, we've been seeing the market moving or the market moves being largely shaped up by the ongoing geopolitical tensions, central banks tightening their policies, supply constraints, and inflation animals being set free without a leash. Now, these are the things which are actually influencing a lot of things. Overnight, we saw oil advancing again with some retreats earlier. Eurozone started working on the new set of sanctions. These things have been keeping the uncertainty going on, Pankaj. So what do you think? How would the currencies be influenced, and what are the reactions of players in the money market? Can you tell us?
Broadly, I think it looks like markets are now taking Russia, Ukraine in a different way. They are thinking that whatever is there, it's in a silo, not impacting much of the market. Uh, but more evidence of more civilian casualties in Ukraine may lead US and Europe to impose more stringent sanctions on Russia, and that is keeping the markets sentiment subdued and dollar bid. There has been no progress in peace talks either. With the increasing talk of Europe going for embargo on Russian energy imports, though officials have been divergent view due to its impact on the economy. Will Europe have its gas supplies from Russia turned off in May if it refuses to pay in ruble? It looks difficult. President Putin signed a decree overnight saying as much, having told the Germans something completely different a few days ago. Will there be blackouts that plunge Europe into a recession? These kind of uncertainties have pushed euro down, which is down more than 1.5% from the high seen in the last week of the March. USD JPY also holding well below 123 as Japanese officials get concerned about rapid move in the yen and its impact and intervention is not ruled out. US markets are positive, mainly helped by a big surge in Twitter shares. Elon Musk has acquired a meaningful stake in Twitter, and that keeping the markets in a good momentum. But the outlook remains clouded to enhance expectations of a Fed rate hike. Inflation remains elevated. Now, market is currently pricing 50 basis, 80% probability of a 50 basis rate hike in the next meeting. US 2-year to 10-year yields continue to remain inverted, though a very negative, narrow negative spread. Oil has shifted upwards again on the more sanction news and basically Russia-Ukraine related things like there could be more sanction. The Iran nuclear deal seems to have run into a roadblock as both sides keep blaming each other for the delay and not acting on a key issues. We have a gold which is stuck in a narrow range. It's basically getting a good support around 1915, 1920 range. Let's see whether this support continue to hold. Our bias is that around these levels, it's a good level to buy for a up move. Indian markets received a very big boost. Equity markets received a very big boost yesterday after announcement of a SDFC and SDFC bank merger. Now, this can lead into some good inflows later on. There were few inflows yesterday, and the news of further inflows with respect to stock markets, equity buying out by foreign companies, and that is keeping positive momentum. There is a support between 17, 5, 10, and 20 or 75, 20, 30 area, which should hold the downside for now, barring any unexpected positive development in geopoliticals. RBI MPC meeting outcome tomorrow will provide direction to the Indian market. That's all from me. Thank you.
Okay, so folks, as Pankaj mentioned, we are expecting RBI MPC minutes as well as there's going to be the Fed minutes being released later this week. So there can be some guidance on the expectations of how rapidly the central banks are looking to raise their rates. Other than that, as Pankaj mentioned, there's still a lot of work and discussions on the kind of sanctions to be imposed, even though they say the geopolitical tensions are in silos. Domestic markets did well yesterday. Let's see how it goes today. Till then, we take your leave. Adio. Thank you.